Joining the program now is Harry Dent. He is the founder of HS Dent Investment Management. He's president founder of the HS Dent Foundation and HS Dent Publishing. He has authored numerous books. I think the most recent is The Great Depression Ahead, How to Prosper in the Crash Following the Greatest Boom in History. And that one was from 2009. Harry, have you written anything since then?
Well, I've got a book coming out in early January called The Demographic Cliff.
The Demographic Cliff. Yeah, that's been one of your themes now, I think, for at least the last few years, and I've heard you speak, and you often talk about demographics as one of the reasons for your outlook for deflation. Why is demographics deflationary?
Well, you know, the first thing is the baby boom generation, the largest generation in modern history. They went through a spending spree from, all I do is move the birth index forward 46 years for the peak in spending of the average household, which is a verifiable fact. There was a spending wave, we call it, for the baby boom from 1983 to 2007. 20 years ago, we said, look, this generation is going to peak around 2007, and it's going to start saving for retirement and retiring, and that's going to slow the economy. But there is something unique that's never happened in modern history. The echo boom generation, the next generation in most countries, and certainly in the U.S., is not as large, does not go to the same heights, the same number of people that are going to be, you know, entering the workforce, spending money, buying houses, borrowing money, all those things that drive the economy. So when you get that, you get the aging of a population, and Japan's already seen that. Japan's baby boom peaked way back in the early to mid 1990s, and they've been in this downward slope, and they've been in a coma economy ever since, even despite endless quantitative easing like we're doing here. So the aging of a population, we show that young people are expensive to raise and incorporate in the workforce, and when they're entering the workforce, you get inflationary trends as we got in the 60s and 70s. When you've got more people start to exit and retire than enter, older people are more deflationary. So demographics has a mild impact on deflation, but that's not the biggest factor we stress.
Right, but also, you know, there's no shortage of young people, certainly in the emerging markets. You've got lots of people that are going to be buying and spending lots of money. So maybe you've got, a baby bust in the U.S., but there are people all around the world, right, that are still going to be out there competing with American and Japanese consumers. So there's plenty of consumption and spending going on, even if you believe that there might be a decline in the United States or Japan.
Yeah, no question. That's what you have right now. You have inflationary tendencies in emerging countries, and our quantitative easing is aggravating that for them. Countries like India and Indonesia and China to a lesser degree. And you've got deflationary tendencies in countries like Europe and the United States and Japan. So you're right. There are two things going on at once, and over time, there's no question there's going to be more inflationary tendencies from the emerging countries. But, I mean, the developed countries are still close to two-thirds of GDP in the world. Emerging countries do have the demographic growth for the future, and they will, as you say, they will tend to have inflationary tendencies as they become
But I would think, though, Harry, that the inflation that's being experienced in the emerging markets is imported from us. I think that their economies that are productive and are producing goods, that would keep prices down. But the problem is the goods they're producing are being sent to America, and we're sending them our inflation. We're sending them the paper that we print. And so that's really what's driving prices in the emerging world, is that they're sending us their stuff, and we're sending them our paper. And so they've got all this money chasing a diminished supply of goods. And in America, we get all these extra goods that we didn't have to produce. So I would think that even though there are some deflationary pressures in the U.S., that they will be overwhelmed by a tsunami of inflation when foreign central banks stop buying dollars and let our currency sink, and then the U.S. government has to kick the printing presses into high gear in order to monetize all the debt and keep all the bubbles inflated.
Yeah, that could happen at some point. But again, what you have is inflation, inflationary tendencies today in emerging countries, and our quantitative easing and money printing is feeding that. But we have deflation. Now, the biggest reason we have deflation is not demographics. The biggest reason is debt deleveraging. If you look at history, every debt bubble, the one that peaked in 1835 and 1872, and then, of course, 1929, and now in 2008, every debt bubble in history has been followed by a deflationary period. Now, not forever. Deflation is always a temporary thing before you return to inflation again. But when debt deleverages, you're destroying money. When bank loans fail, money is disappearing that governments created and the economy created. But every time we borrow money, we are creating money out of thin air, whether it's government bonds or whether corporate borrowing, consumer borrowing for mortgages. We're creating money, and when you have a debt crisis like the 1930s, that money gets destroyed. Now, what's happening, though, is our governments are not letting this happen like they did in the 30s. They're just saying, no, we're going to print money to stop this debt deleveraging. Japan never really let its massive debts deleverage very much, a little bit on the corporate side, but consumer debt didn't deleverage, financial institution debt didn't deleverage, and government debt's gone from 60% of GDP to a whopping 250%. So they have more debt than they did before their crisis set in. So for the first time in history, governments are saying, no, we won't have debt deleveraging. We won't take the consequences of our excessive borrowing, and we'll just keep the bubble going forever. Well, obviously, there's no way you can keep the bubble going forever.
That's where I would, take issue with you, because I agree with what you're saying. But if you look back at the period of the 1930s, right, we were still on a gold standard. Money actually had value. The government couldn't create it out of thin air. Even though they devalued the dollar in the 1930s, it still had real value. There was a limit to the money creation. But if you look at a pure fiat system where there's no limit to how much money the government can create, they can create enough new money to prevent deflation in terms of that currency. They had hyperinflation in Weimar Republic, Germany. I mean, they had lots of debt, and that didn't bring about deflation. It was runaway inflation because the government chose the monetary easy way out. They print a lot of money, and I believe that you're not going to see the deflation in terms of dollars. I think where you're going to see it, Harry, is in gold. If you want to think about gold as money, and you want to think about what's going to happen to the price of stuff, and particularly assets like stocks or real estate priced in gold, then I think you're going to see a bigger deflationary collapse than what we saw in the 1930s. But if you're going to talk about it in terms of dollars that they can create out of thin air, they could literally drop trillions of them from helicopters. The dollar could lose far more value than anything else that you would buy with it.
Well, first of all, Peter, the dollar has not lost value since this crisis started. We went into recession in January of 2008. The dollar went up 27% at best when Lehman Brothers was melting down, and it's still up 10 to 15% from there. The dollar has not been going down only because, yes, we have been printing money recklessly, but other governments, Japan and Europe, have been printing as much or more. So everybody's printing money, and currencies trade relative to each other. So the thing is, to me...
Sure, but one of the big differences, Harry, is that...
Peter, just wait a minute. We'll only see deflation. We haven't seen it yet for good reason, because we're printing money to stop it. Only if debt deleverages. We've seen about $4 trillion in private debt deleverage, but we've seen $7 trillion in new government debt. So net, we're not deleveraging debt. You only see deflation if debt deleverages. If governments can keep debt from deleveraging, then you're right. We will not see deflation in dollars or anything. And the other thing is gold is going down. So I've been predicting because we've had 5 years of unprecedented money printing, and inflation's gone down, not up. So when gold saw that this year, gold said, oh, my gosh, I was expecting inflation.
Yeah, well, gold's gone down now 1 year out of the past 12 or 13. So, and I think, this is not going to be a new trend. I think gold's going to resume its ascent. But, most of the money printing that's taking place, certainly in the emerging world, is simply to buy dollars. So they're printing money to buy our money, to prevent their currencies from rising. But you had a big announcement out of China a week ago. China is now saying we don't want to expand our balance sheet anymore. It's not in our interest. So they don't want to keep printing money. They don't want to keep buying dollars. They don't want to keep buying treasuries. So that means the Fed is going to have to print even more money and buy even more treasuries to pick up the slack from China. And, of course, if China stops buying, there's a whole host of countries that are also going to stop buying that have been in a competitive devaluation with China. So I think that it's only a matter of time. Yes, the dollar hasn't collapsed yet, but I think it's going to collapse under the weight of all the inflation that has already been created. And also, Harry, the government does not want to let interest rates rise. When they talked about tapering and then interest rates went up. Yeah, so they backed off. The federal government now, I just mentioned it earlier in the show, is now monetizing 150% of the annual budget deficits when you look at what they're buying in mortgage-backed securities and treasuries. This is the highest ever. So the government is more addicted and more dependent on QE than it ever was. And not only can they not take it away, they're going to have to increase it.
Yeah, Peter, I used to think, there's no limit. The government will only go so far. Well, I've thrown away that belief real quickly. They will print more and more because they're in this game. They can keep doubling down their bets, and they have to keep in the game even though they're holding a bad hand, just like Germany holding a bad hand, bailing out Southern Europe. But they have to keep doing it or the whole thing falls down and Humpty Dumpty falls off the wall. To me, what happens is what could cause deflation temporarily would be if there is a financial crisis, if despite all this money printing, that interest rates keep going up and the U.S. real estate recovery fails. Europe, Greece, bad loans are going straight up in Greece and Spain, even though there's some recovery in Europe. If those countries have a banking crisis and need a big bailout, that could cause it. But the biggest thing I'm looking at, Peter, you're talking about, us printing money. China is printing condos and just overbuilding infrastructures, commercial real estate, unlike any country. They're driving their economy from the top down. 50% of GDP is government investment and building shit for nobody. It's unbelievable.
Right, but a lot of that, Harry,
a lot of that is the byproduct. It's going to be like an elephant falling over.
Well, a lot of that, though, is the byproduct of their monetary policy, which is to prop up the U.S. dollar. In order to prop up the U.S. dollar, they have accumulated trillions of reserves, and the temptation is to spend them on something other than U.S. treasuries. And so the government has all this money, and they're spending it, but they wouldn't have any of that money if they simply would have let their currency rise. Their citizens would have that purchasing power, and Americans would be stuck with all the inflation that we've created. We wouldn't be able to export it abroad. But I want to get to one point, then you can rebut it or take it on after the break. But you mentioned that the one thing that really could bring about deflation is a big financial crisis. But wouldn't the government's response to any financial crisis be even more money printing? Because if we have banks fail or real estate markets crashing again, we're going to get more QE. If the Fed goes from $85 billion a month in QE to $150 billion a month to $200 billion a month to whatever, who knows? I think that they will print as much money as they have to get the economy going. And even though it's never going to work, even though all the money printing will make it worse, it just guarantees that we're going to have more money printing. So I think a financial crisis is going to be inflationary because of how the government responds to it.
Well, last time we had a crisis, the Fed did eventually come in and stimulate more strongly, but they lost control of the economy first. I think if Southern Europe blows up, if China's bubble bursts, and it's the biggest bubble I've ever seen. I've been studying China nonstop for the last year. It's just daunting what they're doing over there. I think that the economy could melt down first. And then they come in and try to stimulate on lag, and it's too little too late, or they just lose credibility. It's 5 years of straight, massive, unprecedented stimulus, which you know better than anybody. And if we go into a financial crisis again anyway, who's going to have faith in the government saying, well, we're just going to double down and do it twice as hard? Now, they may be able to pull that off, and the degree they do, you're right. They'll come back, and they will certainly try to do what you're saying. I have no question about that. The government's in a bind here. They created a bubble in the 90s and 2000s. They do not want to burst because they know how deadly it's going to be, so they'll do anything to keep this bubble from bursting. They are trying to keep a bubble going on forever. Anybody knows. I don't know how long it's going to take. I think it's going to burst early next year. That's what my indicators suggest. But you can't keep a bubble going forever. At some point, this thing will burst, and it will be only worse because they propped it up even more. So, yeah, I agree with you on one thing. This is the most reckless, dangerous, stupid monetary policy in all our history. The only time we've done anything close to this was in World War II, where we issued massive amounts of bonds and bought our own bonds, which is cheating. But we had to do it in a war period. You should not be doing this in a normal economic period. This is just
and of course, Harry. when we were selling all those war bonds, the American economy was flush with savings. Americans had the money to buy the bonds, and American consumption. See, domestic consumption went down to accommodate the increased consumption and spending on the military. So Americans responded by making a real sacrifice. They stopped buying things for themselves during the war years so that those resources could go to wartime production. And so when the war was over, we were able to cut back on a lot of government spending, and we were able to repay those debts. And we had a productive manufacturing economy that we could rely on. We don't have that anymore. But, you know, what I think Janet Yellen is going to do, I think that the Fed regrets the fact that they acted so slowly in the financial crisis of '08. They underestimated. They really underestimated the impact. They underestimated how much of an effect their low interest rates had on the housing market. They underestimated the counterparty risk, the degree to which banks and the consumers relied on home equity. So they were too slow, and they regret that. I think they're going to make up for it this time, and they are going to put that monetary pedal to the metal. They've already got interest rates at zero. So the only thing they can do is bigger QE. So it's pure, you know, injecting that inflation right into the economy. And plus, I think in the next downturn, the budget deficits are going to skyrocket in addition to Obamacare. So you're going to be talking about, you know, budget deficits much more than $1 trillion that the Fed's going to be monetizing. So they could be printing $2 or $3 trillion a year. And if the world doesn't absorb all that inflation, and I don't think it will, then I think the dollar gets killed and we get runaway prices.
Here's the only problem, Peter. We don't control China and Europe. Yeah, we can print all we want here. China could have its own collapse and crisis, and that would reverberate. See, we generated the last crisis. It was a subprime crisis in the U.S. that triggered a global sell-off in stocks. So I don't see it coming from the U.S. this time. I see it coming from China and Europe, and we don't control that much. And if they go down, believe me, we'll go down at least for a period of time.
Although I don't even look at it as China going down. I look at it as China, you know, getting smart. I think that, you know, if the Chinese stop, you know, supporting the U.S. dollar and we see a doubling or tripling or more in the value of their own currency, you know, there's going to be a restructuring in that economy. There's going to be winners and losers. But net, China is going to be in much better shape when they can, you know, produce for themselves as opposed to producing for us.
I don't see China. I see China as the biggest bubble ever, and I'm going to bet anybody on this, biggest bubble ever to burst. Real estate is up 6.6 times since 2000 when the real estate bubble started. It would have to drop 85% just to correct that bubble, not the past gains. And most bubbles go back to where they started. So that would be devastating for China. They have bigger down payments, so it's less of a bank insolvency thing, even though it's partially that. The rich Chinese control 85% of the real estate, and that's all their savings. They save 60 to 70% of their income and put almost all of it in real estate. They would be devastated. They drive 60% of the income and 50% of the consumer spending there. China would have
I think that real estate prices will come down in their own currency terms, but their own currency will rise dramatically in value. So the net effect on their purchasing power and their position in the world.
35%. That'll kill their exports, Peter, which are 35% of the economy. Then they're dead from that. China's got nowhere to go but burst.
They're going to consume that production. No, they're going to consume that production. They're not going to need to export it. Their own consumers are going to have the purchasing power to afford it.
The biggest real estate bubble burst where they got all their savings. You think they're going to keep spending?
No. They're earning their wages. They're earning, and their cash savings are going to go up. But Harry, you know what?
Right here on the radio, we're going to make a bet. China bursts in the next 3 years, and it bursts.
All right. Well, we'll have to
go down hard.
Well, I think if China bursts, it's much worse for us, just like the Great Depression was much worse for the UK than it was in the U.S.